Simon Dixon here, and I'm going live for another emergency broadcast. When I do emergency broadcasts, they're not meant to be common, but now it seems like we've got to do another emergency broadcast every week because the whole world is full of emergencies. So the news, if you have not heard it already, is that FTX was levered up with a flywheel on a token, and we're going to be discussing all about that, and then we're going to head over to an AMA. So I'm going to rant for approximately 30 minutes, and then we're going to head over to Twitter Spaces to take your questions. I want to share one slide that I shared with my team towards the end of last year, early this year, when forecasting what we need to be thinking about as a community. And the FTX news really is about this whole flywheel concept. So if you didn't see Dirty Bubble Media's revelations that really led to the latest over the last couple of days, in fact today, with the FTX situation, it was really exposing a business model that we've been trying to warn about throughout this whole Celsius saga. So everybody on these public Twitter, if you go back and if you haven't watched it all, it's going to really make some of the history books. I'm obviously going to be covering this in my next book, which I took a break from in order to really go through. And there was a whole chapter on the history of Bitcoin and 5,000 years of monetary history where I was tracing all this stuff. And I always like to go back to first principles history in terms of what we can learn. But this will be covered because many people were trying when I first started figuring out what I would do in order to turn the Celsius saga into something productive. Everyone was having a go at me for saying that it should be, there's this millions of dollars of value in the Cell token and we should build on top of the Cell token. And I was trying to warn everybody that a business model built upon a token is not a good business model because it exposes you to a line of attack, securities laws, issues, and then all the issues that follow from it. And now we're getting to experience that in real time with the collapse of some of the biggest players that were leveraging billions and billions of dollars by essentially launching a token, adding it to their balance sheet, and then really showing themselves as a very, very large company in order to entice investors in so that they can leverage equity valuation, raise finance based upon equity, and then keep pumping that token in this flywheel and eventually accidentally end up in a Ponzi-like scenario where you require a bailout and the whole community asking you to figure out how you rescue that token. And the cold hard reality is that we've got to get back to first principles of what this industry was created for. And I rewind before Bitcoin was created, when I wrote this book, or I started writing this book, Bank to the Future, Protect Your Future Before Governments Go Bust. And I was trying to talk about the unsustainable nature of creating money as debt. And we recreated the whole cycle in the crypto markets. Essentially, we created digital hard sound money. I was trying to create a bank where you could own your own money, you could spend your own money, and you could, and it wouldn't be rehypothecated and re-leveraged. Unfortunately, it was impossible at the time, or fortunately, because it really ties into the whole story, bringing everything up to where we are today before we go into the AMA. So the three fundamental principles. When you deposit your money at a bank, the bank becomes the legal owner of your money. When they become the legal owner of your money, they can spend it as they choose, and you need lots and lots of regulations in order to keep that system alive. Then they have the ability to create money as debt and rehypothecate money. So every time you borrow money, it creates a new deposit, and we end up with this large wealth inequality, and you have to rehypothecate the Ponzi scheme with central banks, deposit insurance, real estate bubbles, bond market bubbles, stock market bubbles, in order to remove slowly free market economics, Austrian economics, build upon hard money until you reach the end of a debt cycle where wealth inequality gets so bad that you have extreme left and extreme right popularism. And if you look back at my emergency broadcast before the Russian invasion, I was talking about how Elon Musk could put in a bid for Twitter, win it, re-enable Trump's Twitter handle, so that then he could be re-elected in 2024, which is inevitable in my prediction, and then be blamed for the fall of the US empire because he inherits a Ponzi scheme where the dollar goes through a slow transition as a result of this over leverage. And then we end up in a monetary renegotiation, as I forecasted in the Great Depression of the 2020s, which leads to central bank digital currencies introducing communism on a blockchain in order to save distressed banks. And we end up with bigger and bigger governments because, at least with fractional reserve banking, banks were one step removed. Now, what do we do in crypto? So when I couldn't create a bank, we went, Bliss Dixon and myself went to the first Bitcoin conference in the world and launched the book, as it were, to the Bitcoin community. And they created money you could own, money you could spend, and money that had a fixed supply. So I'm going to switch over to a slide right now, because that really brings us to the slide that I gave to our internal team, that with these centralized companies, regulations is essential, and decentralization is essential in order to regulate the regulators. So we're going to end up in my whole Great Depression of the 2020s theory, and the theory in the book that I wrote in 2011. And I'm not trying to shill the book. You can get it for free at retirementplanb.com/book, where I give away the PDF copy. And it will be much upgraded in the next version of the book once we get through some of these restructurings that we're currently working on. But it talked about separating custody and investment accounts so that when people are investing, they know, and you have hard money so that you don't need to use these assets as savings accounts and rehypothecate Ponzi schemes based upon debt. And it said that in order to deleverage that, you're going to need modern monetary theory, as it's called today, which is where governments actually, or central banks, introduce a new money supply not backed upon debt, and therefore you end up in a deleveraged left free market scenario. But you have the bond markets and peer-to-peer and the different technologies that I talked about leading to digital money based upon the mobile smartphone, peer-to-peer lending, crowdfunding, and the different trends that we talked about. And we did a whole time travel journey, look back and forth in that. So what did we do in the crypto markets? Well, we created digital hard sound money, Bitcoin. And because human nature, if you create hard money, you do what you did at a bank, essentially. When you've got hard money, you don't want to sell your hard money because of Gresham's law. And so therefore you take a percentage. You don't have to invest in savings because essentially hard money becomes your savings. And you take a percentage of it if you're smart and invest it. And you don't bet everything on those investments. But obviously when you remove savings, people have spending money, which is fiat, and savings, which is hard money, and investments, which is where you try and outperform and you can take risk, which is good for the economy, so that new things get created and businesses get created. But you do it based upon wealth rather than leverage. Because when you do it based upon leverage, you end up overexposing yourself where you continually do this. So the lesson of all of this, and many people will say, there's obviously the vast majority of wealth should be money that you can own, money you can spend, and money that has a fixed supply, as we've always talked about at the Retirement Plan B video series. But when you are investing, you need to do it with money management, portfolio management. And the reason that I ended up with Celsius in the first place is because I was looking for a way to not sell my Bitcoin, borrow against it some dollars using Gresham's law, where you spend the money that goes down in value and you keep the money that long-term you believe goes up in value. And therefore the service was created. And I also wanted to have more there. So that I could pay the interest on a very small percentage of my wealth. I ended up exposed to approximately $45 million by doing this. And it's now worth about $10 million, which makes me the 21st largest creditor because of that. Now, I'm not thinking about that in terms of dollar value, because I've always talked about this concept of Bitcoin thinking, where these markets, if you're a Bitcoin thinker, allow you to use your fiat in order to purchase more Bitcoin, as long as you've used sound money management, where you're using fiat in order to meet your expenses. You've got sound money or hard money as your savings, and then you can take a percentage of your savings and invest it, or use more advanced strategies like this, because it's money that you can lose if it all goes wrong, or money that does well when it goes right. But when people build these businesses, and this is where I'm going to turn over to the slide, based upon a token, which is what I was trying to warn everyone against, that the backbone of these tokens, people are always telling me that you need that token as a war chest. Then you end up rehypothecating the whole situation, especially when you start using that token as leverage. And collateral should only be pristine collateral. So when we came out, I said that we should only use, you can have all of the crazy stuff, staking, whatever, as securities, because securities is investments, and investments is money where you allocate because you can lose it or you can do well. But borrowing against pristine collateral should only be done with pristine collateral, so that you can manage a much smaller amount of risks in order to really rebuild these models. Now we end up in a situation where everything is blowing up. We have the FTX scenario. So before I go through the FTX scenario and we move over to the AMA, I'm just going to remind you of this slide that I presented to the team, because I think it gives us the lessons. Now, firstly, many of you will just leave the markets altogether, say, this is a crazy market. But I want you to know that you only understand Bitcoin once you have lived through a 4 to 5 year cycle. If you survive through a 4 to 5 year cycle and you dollar cost average in, not financial advice, but historically, and I'm not saying the future equals the past, but historically, nobody's gone wrong with that type of investment strategy, and it's led to some of the biggest wealth in this industry. Now, the other side of that wealth, which has been destroyed, is when people launch their own tokens and essentially create their own equivalent of fiat currencies, but in the crypto market. That's but it's destroyed wealth for those creators that have over leveraged and not learned the lessons of separating your spending money, your sound money, your savings, and your investment money, and put pretty much everything into the investment account. So here was the slide that I gave. We're way back, it's 2009, the Bitcoin white paper is out, and we start getting the first exchanges with Mt. Gox. And Mt. Gox eventually blows up. When I spoke at the first Bitcoin conference, they were the sponsor. And about 70% of the market's Bitcoin was on Mt. Gox. And now, all this time later, people might get about 10% of their Bitcoin left. But forward all of that, and everyone starts creating tokens, and everyone comes up with all these different models for creating tokens. We have several exchanges. We invest in Kraken. Later, we invest in Bitfinex. You have the explosion of Cryptsy and Bitcoinica and all the other ones that do that. And we enter into the market where, rather than using an exchange that built their whole business on a token, we use security tokens as debt and equity. And we had the Bitfinex scenario where they filled their 119,000 Bitcoin hole. Now, interestingly, the reason that a hole was created is because they were trying to create a new feature called proof of reserves, where everyone could verify their own reserves. Obviously, a very important feature in the current market, but it required using a service called BitGo, and there was a vulnerability in BitGo, this custody service, that led to the hack that this year, the crocodile of Wall Street got caught, because they were part of a syndicate that hacked those Bitcoins as well, and they got caught trying to spend those this year. So we ended up in the Bitfinex scenario. They used a security token rather than building a whole model on a token, which is then over leveraged. And that led to Binance being created, where they essentially leveraged Tether, which was created, so they didn't need banking services. And they started launching unlicensed, unregistered securities offerings, and that led to the ICO boom. The ICO boom forgot that securities laws and all the lessons of the past where, things were created like the DAO, which ended up blowing up, as I covered it. If you haven't watched my Halloween video, I covered the 10 scariest moments in crypto, and we had all of these unlicensed securities. But everyone forgets that they build this new innovation, Launchpad on Binance, and the ICO boom persists because people start using stable coins, and we enter into a boom market. Then everyone gets hacked, everything blows up, the over leverage comes out, and all of these ICO tokens crash. And all of the businesses that had a token as their backbone end up in severe trouble. And those companies that don't just maybe had a token that was used for just some utility, but wasn't the backbone of the whole model, end up essentially in a boom, a crackdown, regulations come along and say, yeah, there's a reason why these centralized companies need to be regulated because it needs that additional transparency, and we end up in the crackdown. That holds our market back. We go through the halving cycle. We end up with a Bitcoin boom again. People generate wealth. They then start to try and allocate some of that wealth into their investment account. And we end up with a DeFi boom where everyone forgets all of the things that happened in the past. Central bankers come along and slap the decentralized label on top of it. And you end up launching all these tokens again, and the whole business gets built upon these fake decentralized tokens. But you get this genuine innovation, which eventually comes through where things can be done on chain as long as you can get those smart contracts. But then you get a DeFi crackdown. And here's what I presented to the team. I said, we need to be ready for the fact that we are currently in a yield boom, and we need to get ready for the yield crackdown, essentially. The yield crackdown this time will lead to what I was forecasting, the boom areas of people finally understanding the lessons by force through regulations, and we end up where you end up in probably the 2024 securities boom leading into the 2024 halving cycle, the election cycle, and a shift in empire as we go through the end of a debt cycle, the blaming of the new president for the fall of the US empire, and whoever gets these cycles right, leading to this extreme left and right popularism in the traditional economy, potential civil wars, and the rich getting richer, the poor getting poorer, which leads to massive left and right popularism, and the crypto markets going through this cycle again, and then you end up in the securities. People learning that you need regulations in the centralized company, but what happens when you have too much regulations or bad regulations in the centralized company? You end up with Lehman Brothers as well, where people take things off balance sheet. They use tokens in order to take those leverage over to the other side. And you repeat this cycle again until you have transparency and securities laws within these token models. And remember, people get scared of securities laws. They think it's like this evil thing, when really it is meant to be disclosure and suitability, so that you don't invest too much in those investments. You don't take your whole life savings and invest it in those investments. And you make sure that you're only allowing people to invest a suitable amount. So now we end up with the situation that we're in today. Luna comes along, and they essentially a stable coin backed by a central banker called Do Kwon. That blows up $40 billion when you realize that they're managing the risks behind it. And we have this cascading effect because we enter back into the 1920s. The 1920s creates these bull markets. We figured out everything. We went through the time traveling journey in Back to the Future, where we went through all the legislations that led to the laws that needed to be put in place in order to understand those models through regulations, but built upon a Ponzi scheme called fiat currency. Now we have digital hard sound money. We go through these cycles again. Luna happens. That leads to the businesses that were most exposed to building their business on a token being exposed. So you had some of the crypto lenders like BlockFi be bailed out by those where their token was working. This leads to them taking on leverage in order to perform transactions backed by their token. And then you have the Celsius scenario where the token gets attacked by the player that's using the leverage as well. And that leverage leads to an over leveraging, and then they expose themselves even further. And you have Celsius blowing up because they created an attack where they didn't get the regulations, they didn't follow the regulations, and they built the whole $2 billion balance sheet on a token that they bet long, essentially, where they believed that Mashinsky believed that the asset would continue to go up. So they invested a bunch of the Bitcoin in a long-term investment, and they went short Bitcoin short-term, exposing themselves to an internal attack because they didn't get the regulations from regulators, cease and desist orders, which then can be used as a token attack where you can take the whole business model down based upon your understanding of their reliance upon these tokens. Then you have the whole thing happening again where Voyager happens. The Voyager happens where it's overexposed to one hedge fund. You have this intertwined relationship between 3 Hours Capital, their exposure to Luna, their trading on Digital Currency Group, the reversing of that trade that then leads exposure to BlockFi, to Celsius, and then Voyager, and then FTX comes in as the white knight, but it turns out that they were doing everything, the leverage based upon their own token. And as an investor in the equity gets to see what are the businesses that don't have exposure to many of these tokens if they are doing their job correctly. And if you had full disclosure, which is where the industry has to go in the future. It has to be that these exchanges and these centralized companies are subject to the regulations that is required because the people need to have disclosures on the risks. They need to understand that there's not shady stuff going on with these tokens and this money printing that's happening on the side, which then exposes them to over leverage and the situation we find ourselves in today. So CZ from Binance executes a perfect speculative attack. It is an equity holder. It unwinds that position. It ends up with a lot of, FTT tokens. It realizes the situation. News comes out that there's this whole shady shit happening where these takeover bids are really about unwinding some of their excessive leverage that's built upon the token. Those leverage gets unwind prior to all the other investors. They are subject to those clawbacks and everything that comes from that. And then we end up with a speculative attack situation because companies are relying upon a token. And if this all ends up in the one company, Binance, Voyager, FTX, BlockFi, then if that all ends up in the one company, then you have to ask yourself the question, is it another ginormous flywheel called Binance? And so this model of how much did they over leverage their token? Is there transparency on that? And are we putting everything into that? Or have they managed their risks effectively? And this is where effective regulations for centralized company comes in. But what if those effective regulations fail? Because there's certainly corruption from regulators. What do we learn from things like the Silk Road takedown that was connected to the Mt. Gox hack? Well, we learned that the FBI were also in on the action and threatening, and we also see that there's strategic moments when these regulators attack the companies, because at the end of the day, they also need to pay for these high tall buildings. So you need effective regulations on regulators as well. We can't rely on them being honest. And that's where the whole DeFi thing comes in, built upon Bitcoin, digital hard sound money, and all of the innovation that needs to move forward in order to really learn the lessons and have an effective regulator on the regulator. So my final messages in all of these monetary renegotiations was that you are going to end up with central bank digital currencies, which effectively takes away our freedoms, and you need Bitcoin in order to have an exit from that system. Bitcoin regulates the regulator when you need the companies that gives people on boards and off boards. That won't go away. And you need effective regulations. We've learned all the lessons in the past with securities laws, banking laws, and all sorts of stuff. So a new model needs to be built that has effectively learned all the lessons from the previous decades. I've been studying for the years and years and years, uses pristine collateral, and everybody understands that it's effective money management at the end. So in 2023, we would like to ensure that finally we end up with many of the lessons learned, moving into the next cycle, that people are using effective money management. They don't exit the market and end up in a fiat Ponzi scheme disaster from one to the other with hyperinflation and all of the exposures of fiat currency as well, a cost of living crisis. We need to learn that there is diversification matters. You can't be exposed to one outcome. You need to be ready for all of the different areas. And that really brings me back to where I started this decade, in the 2020s, which was the Retirement Plan B video series, and really us building a model together from all of this. And so we will see next. It looks like, so Binance made the announcement that they've entered into an agreement with FTX.com. FTX has an agreement in order to take on Voyager. They'll finally get some vote on that through the Chapter 11 process. The SEC reached a negotiation with BlockFi. BlockFi is fast-tracked to try and become a public company, and Celsius, who made enemies with everybody because of a founder that made enemies with everybody. And we see all this intertwining through the examinations of all of these relationships as they unwind, and we enter into the process. We cannot allow everybody to get caught in all of that mess because there is an outcome that we need to understand, that if you can get the lessons of regulated custody, regulated securities, and regulated effective lending, implement that into the CeFi model, have Bitcoin as digital hard sound money, and exit from the traditional financial system, all of the innovation, that can be built on top of that to compete with the attack of central bank digital currencies, which are inevitable, predictable, and guaranteed because we've been running a multi-decade fiat Ponzi scheme that ends up with extreme left and right popularism, wealth inequality that drives people into escalating into trade wars, currency wars, speculative attacks, tech wars, and also, tragically, military wars as well. So when those things happen, we need to be diversified for many different outcomes, and we need to build a community that really understands from these different trends what that means and is never exposed to one outcome and doesn't run away into the fiat Ponzi scheme because they're fed up of some of the centralized companies and the practices that they have put together. So, as I said, let me look how we're doing for time. We are exactly on time on this 30 minutes broadcast. I'm going to head over to Twitter Spaces right now, and we can get a bit more geeky and into the weeds of what happens next, do some more predictions, chew the fat around some of these events that are happening. But the big news is that the bigger they are, the harder they fall if they're building a flywheel and is built upon a token that leads to a speculative attack. And that's why at Bank Future, when we essentially launched that token, we never made it a backbone of the business. We've never promoted it as an investment. We've only ever used it. And in fact, all the tokens are still there where they originally were because we wanted to calm down and wait for the security token market to reveal how it's going to reveal itself. People just started to use it, but we never promoted it as an investment, never got people, never leveraged it, never used it, never even moved it, because we believe and started investing in the growth of the security token market as soon as we realized, but it just took a while for this industry to catch up, and started investing in the companies so that that new industry can emerge as we realize that we are in this market of digital hard sound money called Bitcoin. It can't be reinvented. Every time someone tries, you end up with somebody that essentially owns the ecosystem. And when they own the ecosystem, you end up in the securities side. We have this innovation called DeFi that can sit on top of all of this. We have this hedge against proof of work called proof of stake. It's probably going to lead to everybody putting it at the exchanges, but we get to continue and recognize that you are alive at one of the most interesting and craziest times in financial history. Many are going to get hurt, but we can use effective restructuring to ensure that you get on the right side of this. Once we figured out how to do this with the Celsius situation, once Binance has figured out how to do this with the Voyager, BlockFi, and all of that situation, and we can ensure that we're not leveraging and rolling everything up from one flywheel to another flywheel to another flywheel, then we can understand that this is really important work. And once we get these company restructurings right, we need to ensure that it doesn't lead to you going bankrupt because you're building a new restructuring based upon a flywheel token, or trying to circumvent regulations by ending up in some crazy model with misrepresentations again. Leaders that are essentially telling you this is a one-way bet, using the similar lessons of the past, and ending up in the same situation again, versus really taking these lessons of money you can own, money you can spend, money that has a fixed supply, being the effective form of collateral, but not betting your entire thing, having spending money for what it's best at, savings for what it's best at, investing is what it's best at, and sound money management in order to manage these different effects. We'd like to give that to everybody in 2023 that's involved in some of these crazy flywheels. We'll be continuing to do that. The bidding process persists with Celsius. The Voyager situation unfolds. We'll continue to do what we can throughout this process for the rest of the year. But next year, we need to get back to business as usual, investing in the industry, really getting through the next wave, because then we move into the Bitcoin halving cycle. This time, I think we'll do everything with securities, being securities, so that you get correct disclosures, correct suitability, and we can rebuild the model while we fund all the innovation that allows all the decentralized stuff to be built on top of Bitcoin and on top of the other protocols. We can continue to do that, but we can effectively manage those risks. We want to do it with peace. We want to do it with love. We want to do it with unity. And we don't want to create flywheels based upon tokens that create these attacks and over leverages and recreate everything that happens within the traditional fiat market. I'm going to go over to Twitter Spaces right now. If you enjoyed this video, please do like, please do share, and please do pass it on to somebody that may be affected by this and thinking of exiting the market. But even if you do exit the crypto market, the Bitcoin market, you've got to still figure out what to do with your fiat anyway. So do yourself a favor. If you'd like to watch a video series, the previous emergency broadcast, get a copy of the first published book in the world to include Bitcoin, head over to retirementplanb.com/book. You can have all that for free. And 2023, once we've got the restructurings for companies and we make sure it doesn't lead to a disaster for individuals, there's going to be plenty of countries that are also going to need these lessons from everything that we built on this incredible journey together. And I'd like to continue sharing it with you. Get your money in custody, allow you to exit if you choose, or allow you to really manage those finances effectively for many of the trends coming forward. So at Simon Dixon Twit, I'm heading over to Twitter right now. We'll do an AMA and we'll answer some of your questions. Peace.